Hello, everyone. We are about to get started. This is Jose Blasco. We got like 45 seconds to go, something like that. I'd love to use this time for a sound check, if that's okay. A quick message in the chat box would do. If you could just type a quick hello, that's nice. And on top of that, now I know you hear me. So that would be a great way to make sure that we get started with all in our favor to have a nice session in front of us. So please go ahead and type a quick hello. So I know all is good. We got 20 seconds and we begin. Thank you so much, guys. Okay, 10 seconds to go. Almost there. And we are about to begin now. Very nice. Top of the hour. Welcome, everybody. Today is June 1st, 2022. This is Jose Blasco. The session name is Options Trading Live. So we are here to trade options. Obviously, options gives us options, meaning that we can approach the markets from a directional point of view, non-directional point of view, and many other things. And in that sense, we're going to be looking at what the market has to offer, adapt to it through the use of proper trading technology, but also through the use of efficient trading strategies, which, as I said a moment ago, they are adaptable to those changing market conditions. Before we get started, I would like to highlight, as always, the disclaimer on the upper left side of the screen. Please read it carefully. It is indeed important information. How are you, Jeff? It's good to see you. I'm counting on you all to read it completely, since it's not that long, isn't it? And it's important, so please read it completely. And when it comes, that's it. I just got the same problem with my background, just like I had the other day. I'm not sure exactly what is happening. Maybe a little issue with my camera or something. So I guess I'm gonna have to turn off the camera because it looks terrible like this. So I apologize for that. It's gonna be the screen. It's not gonna be me today. And and then when it comes to agenda for today, we're gonna be looking at the market environment, try to understand what's happening. We're going to be looking at the trades that we have and review those trades and talk about management if needed. And from there, look into new trading opportunities. That's it. So let's begin. Question page. Very quick before we get started, especially for the ones of you that may be watching this recorded. It's very useful for you to know that you could access our question page using the link tradewithufos.com/Jose. When you go to this page and you scroll down, you'll find a spreadsheet, you'll find the various sections to subscribe to our apps if you're not yet. And then finally, here in the bottom part, you get to the questions section. So when you come to this question section, there are multiple questions. There are many actually questions already placed or posted by other members of the community. You can certainly search for answers and you may find what you're looking for. And if not, you can just click on the green button and type your own question. I would recommend that you add screenshots of the charts and things like that to make sure that your question is rich, so we can give you as well a rich answer instead of we need to answer your question with a question because we need more info, okay? So make sure that you are generous when posting your questions, especially with graphics and screenshots and so on. Anyway, so here is top. Let's begin our analysis for the markets. I'd like to start very quick with the VIX, just to show how the implied volatility went from a higher price point of 36+% all the way to 27% now, reacting to those green UFOs in the bottom part of the chart and coming back up a little bit. So again, the volatility of 26, 27 is not low, right? If we look at it, not too long ago, we were dealing with volatilities here on the left. That was back in April. We went as low as 18, so 1845 to be precise. So we are talking about 26.64 real time. It's not that low. It's kind of like somewhere in between, somewhere in the middle. So it's not too low, it's not too high. In that sense, I'd be happy to be a buyer of options. I'd be happy to be a seller of options. All of it would work. No need to have a preference in a case like that. Okay, so then, of course, the understanding of how expensive or cheap high volatilities combined with the very specific volatilities we find in individual stocks, because sometimes the VIX is 27, but you got stocks with volatilities of 100 plus, or stocks with volatilities of 7%. So depending on what the S&P is doing is a great guide, but then those individual stocks may also behave differently. So we're going to be looking at the volatility of the S&P, which is the VIX, as we are just doing right now, but we will also be looking at volatilities of individual stocks. So my point was that given the fact that on the VIX, the volatility is somewhere in the middle, I'm happy to be a buyer or a seller of options. So the volatility of those individual stocks, together with the market analysis that will provide us with a directional bias to either go long or short, go non-directional, which we're gonna do now, will basically dictate what type of trades I'm gonna be looking for later in the session. Okay, just using common sense here. Mark, how are you, my friend? We missed you the other day. Good to see you with us today. So here's the S&P. Okay, so we are now looking at the S&P, and the first thing I would like to point out is the fact that for multiple days we've been seeing a non-confirmed climate to the upside. Okay, I'm not surprised about that, to be honest. Okay, even though it's not about trading, it's not about predicting or being proud of a prediction. That's maybe more for market analysts, if you wish. Because they get paid for those predictions. We get paid for taking the trades, which is a different related, definitely a related activity, but totally different job. So now, why am I saying I was expecting it? Well, because if you look at since those red climates became extended, okay, longer than what statistics suggest, which is 3. The next time we got a pretty significant blue climate, the beginning of this blue climate was multiple non-confirmed conditions, right? But then finally it defined itself, and then we had a very strong push in the markets, as you probably recall. Well, in this case, it seems that the market is not really defining itself. It's really not defining itself, and I was expecting a little bit of hesitation, even though between us, this move to the upside, it's strong. It's not like this is a weak move. It's pretty strong. But within the context of all the market data that AutoClimate utilizes when doing the analysis, well, in the end, it doesn't seem to be that strong statistically speaking, right? That's why the climate is unconfirmed. So I'm not too surprised about that. And now the key question was going to be, okay, so as we're getting this confirmed climate, which we never got, okay, so let's say it had been today that it was confirmed. So the question would have been, okay, so now do we have implied volatility of the calls above the puts or vice versa? Do we have the blue line above or the blue line is below? And in this case, the blue line is below, which even if the climate was to be confirmed, the fact that the blue line is below, it's certainly a bad sign for the moves in the market to continue to the upside. Okay, so now on top of that, we do have a non-confirmed climate. So certainly it's looking slightly bearish. Of course, the dot is still blue. We have to respect that. We cannot call it a down climate yet. For us to call it a down climate, we will need to see the thick red dot. And then let's attack and put positions to the downside and add positions to the downside to a portfolio. But right now it's too soon to do that. So my preference, okay, given the analysis on the S&P today, my preference would certainly be to look for non-directional opportunities. This is probably going to be a more balanced approach to trading, more in sync with what's happening in the market as of now. Of course, I would not be surprised in 1, 2, 3 days that the climate changed from blue to red. Statistical duration of a blue climate is 6. We are dealing with 4. So maybe 1 or 2 more days of blue, still non-confirmed probably. I will not be surprised. But when it changes to red, like I expected in the prior climate, which to be honest, I was not that right. But if you recall, a few sessions ago, I even changed the background on my video camera. It was red color because I was fairly bearish. We had confirmed climate, we have a gray line above the blue, etc. So if we go back to that scenario, I would be just as bearish as before and ready to ride powerful moves to the downside, like many of those moves that have been happening. But it's just a bit too soon. So given the fact that volatility is not too high, not too low, given the fact that the market conditions are not clearly biased to any direction, it's a non-confirmed climate with a blue dot with the gray line above the blue, which is a contradiction with the blue color. So because of that, non-directional is my approach. And because implied volatility is somewhere in the middle, I'd be happy to do both non-directional iron condors as well as doing non-directional double calendars. I'd be happy to approach that based exclusively on the implied volatility we found on those stocks. So later when we do stock research, whatever is available, we look at it and see what's best, okay? But this is basically the end of my market analysis, okay? And if you have any question or any comment, please let me know now, because now I'm about to move into positions and talk about those positions, okay? So where are we at? The first position I would like to comment on, which is going to be a quick one, is Verizon. So this is a trade that we have running for some time now. Joe, wouldn't you expect a retracement to the EMA? Yes, I would expect a return to the EMA on the S&P, and because the climate is not is still 4 out of 6, it has not reached the statistical end. I would certainly also expect maybe some sort of a reaction or a bounce. But given the fact that the climate is not confirmed, I would not expect that reaction to be such a strong continuation. On top of that, the gray line is above the blue, so puts are winning against the calls. And again, there are sellers in the marketplace. So if the market tries to go higher, probably it's going to hit some sellers and go back down. So yeah, so I would not expect that very strong reaction. Okay, I would be more inclined to either do non-directional trading, like what I'm going to do, or on the other hand, position myself short the moment we get the confirmation that the climate changed from blue to red. Okay, but I would not be relying too much on the blue climate, which is the current one, again because the dot is thin and implied volatility of the puts is above implied volatility of the calls. Again, gray line above the blue. Okay, Joe, hopefully this answers your question. Again, and in those sessions, and this is for the ones of you that may be new, the ones of you that may be watching this recorded and it's the first time. In these sessions, obviously, I love to guide you and demonstrate and educate and all of the above, right? So I love it. But obviously, everything I do is based on my own trade plans, my own set of preferences. It has to do with my trading style, etc., etc. There are variations to whatever I discuss in the sessions, whatever I do in my own trading. There are variations that could make a lot of sense and could be very valid trades. Okay, you guys often come up with questions that kind of reveal variations of the methodology I use myself that could be just as smart or smarter that what I do myself. Again, the thing with trading, and this is something that it took me a while for me to absorb and digest and accept somehow when I started learning how to trade a long time ago, is that we don't know the future for sure, and therefore there is no point in trying to be perfect or a very much of a perfectionist, which I am, including the fact that my background before trading was engineering. So you could imagine that I was really seeking for perfection in my early stages, just to realize in the end that if you shoot for too much of perfection, in the end what tends to happen is that you trade very little. And I'm not saying that's bad, but that was frustrating to me. So in that sense, I learned throughout the years that being a bit more open to less perfectionism and therefore accept many more trading methodologies as valid makes a lot of sense. And as long as you manage your emotions, manage your risk, use the right strategies, input those strategies properly, and so on, you could be in a very good position to profit from the markets in a consistent basis. Of course, I always recommend that you know your stuff, and that means that you understand what you have in your hands, you have backtested your methodologies, you know what's the expected performance, you have created a trading plan around that, it's written, you follow the plan with discipline and all of this, right? But again, I'm deviating from the session today, but it's an important point, especially for the ones that may be new to the session or watching this recorded, that you understand that I'm just showing you what I do, which is not the only way to trade, even though it's my favorite way to trade because it's me, okay? But feel free, guys, when you have questions or if you have different trading styles than me, feel free to interact and make suggestions or comments, because while I trade the way I trade, I could certainly add comments or maybe insights or maybe have questions for you on certain things that you do that may reveal key advantages of your methodologies that you may not have noticed yet, or maybe some possible or potential problems that may happen from time to time that you may not have thought about. So again, be interactive, be engaged, do not be a stranger, do not be shy. We are here to enjoy the markets which we love. We are here to learn. We are here to enrich each other. I'll be the guide, but feel free to take the lead anytime in the chat box and go for it. Okay, very nice. Thank you so much for that, guys. So anyway, Verizon. Okay, so with Verizon, if you recall, we got into this trade when Verizon came into our speed bump. We had this green UFO below, which we used to sell puts again, and in exchange we then ended up buying calls, right? And then we are now enjoying this move riding up where our target is located at 52 and is getting closer, 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 even though this is such an extended climate, 11 out of 3. So I believe I said that the other day. Actually, it hasn't happened yet, but probably we have to see the market go down before it goes higher. So because of all of this, we converted in the prior session, we converted our Verizon position to be a bull call spread, okay, risk graph. So we got many items here because that was the whole detail of the tweaking of the strategy the other week. So I won't comment on that to not to review myself. But basically, we are now left with a bull call spread. Okay, everything that you have here you could ignore. The only thing not to ignore is the fact that we are long the 52.5 call, and we are short the 55 call. Okay, those are the two units that we kept. The other ones are entering and closing positions, so they don't exist anymore. So in other words, when we add all together, we are currently producing a P&L of $87.5. And of course, the idea is that that stock is going to go at 50, it's going to reach 52 or more. And if it reaches 52, then of course, we'll reach the target. So the idea will be to close it and that's it. Now, if the stock just like goes like crazy to the upside, gaps up, we get to see the volume map, things like that, that suggest prices are going to continue much, much, much further. The other day we talked about this potential 55, isn't it? So then you could choose to leave the trade open, knowing that the maximum profit you will make in this trade could be up to 286, where the maximum risk you have is actually a negative risk, meaning that you cannot lose money. The worst case is to make $36. Notice that even if that stock falls, everything is green color. Okay, so worst case you're gonna make $36. Currently we are making 87.5 per contract. If it rallies all the way to 55 or above, you're gonna make 286. Okay, so again, that's what we have in our hands. Again, the conservative plan will be to close it when it gets to 52. The less conservative plan is to ride it all the way to 55. Okay, the next trade, which was concluded, is Lulu. This trade concluded last Friday after tweaking this iron condor all the way to an iron butterfly. Finally, this trade that was very challenging, actually this trade ended up as a profit. Okay, not sure how many of you were in the trade, how many of you managed it until the end, but you can see here the chart. Okay, it was a very good exercise actually. When that stock started falling like a rock and getting very challenging, and we had to do 2 tweaks and then hit the blue line, where I missed the tweak that day, but I did it on that day. And then the trade was converted from iron condor to iron butterfly, creating a small portion. I don't remember the exact new break-even points, but let's say it was inside that zone. So it created a new zone for profitability with a much lesser risk. So we gave the trade a second chance. So if the price of this stock was going to be trading in that area at some point, we could leave the trade at a profit, which it did, as you can see, and at the same time we did reduce the risk, meaning that if the stock had continued falling and never came back, so then what you would have lost was, I believe it was 100 plus instead of 500. Okay, so it was well reduced while the trade was given a second chance. And again, if you acted on that day, you could have exited the trade for a profit, and that's it. Now, important point, if you left the trade open on Friday, it closed at 293. And because this iron butterfly was made of the 290 call, then the 285 call and put, and then the 280 put. Okay, that was the butterfly we got. Well, because 293, which was the close on Friday, is above 290, right? So then this trade would have actually produced that loss, the $100+ loss that I was talking about. So waiting until Friday was a bad idea, but acting on it on Thursday would have basically given you the opportunity to exit this trade for a decent profit instead of losing money on this trade. Okay, which was a great exercise that illustrated very nicely, very powerfully, the importance of trade management. And finally, talking about trade management, we have another trade here with MasterCard, which was a trade that we entered on that day, and it's like almost like these cases where it feels like the market was watching us, and it did the complete opposite the moment we entered. So we entered with a bearish position on MasterCard, and next thing you know, it went to the moon. very, very, very strong move to the upside. Okay, so anyway, obviously the trade started suffering the consequences of stock price moving in the opposite direction. So what we did is that we took this trade. Okay, we took this trade, Mastercard, risk graph, and this trade that was originally, as you can see here, a bear call spread, we actually converted it into a different type of trade where the risk profile still remains as the same risk profile of a bear call spread. Okay, but now because we are using puts combined with the calls, okay, we also manage to lower the risk to a much lesser level. So the risk of this trade is now 185. Okay, 185, and if the stock drops, okay, so we still have until June 17 to end up in that green zone, which based on probabilities it could happen. Okay, the purple line is still inside the green zone, so we may end up this trade with a profit, even though right now it's not looking good. Even though while it's not looking good, it's looking okay from a management point of view, because the current risk of this trade is $185 per contract, where when we started, the risk of this trade was more, and to be precise, the risk of this trade was 240. Okay, so we have reduced, okay, the risk, and given the trade a second chance. Now, because that stock has not started moving or done anything yet, so we cannot comment more on that. We just need to be waiting more, expecting it to come back down. The reason why I have certain expectation of this to come back down is because it belongs to a weak group. That stock was selected as a stock that belongs to a weak group. So while the stock has shown a lot of strength by itself as a company, within the group there is weakness, and if the group was to get hardly hit, that stock may just fall like a rock. Like you can see the speed of movement that could happen at any moment in time, and if that was to be the case, next thing you know, we're back in business, my friends. Okay, so again, just managing the trades, always trying to spoil in a positive manner, and, our risk, our reward, right? So trying to massage the various components of the trade, to treat them well, okay, to treat them well, so that way our portfolio keeps producing performance little by little every day, every week, again, depending on the time frames you use and so on, okay? Cool. So anyway, with all of this said, it's time for me now to change direction in the session and move from market analysis and market review to finding new opportunities. Okay, so for that, I'm going to call the matrix. But before, I'm going to take a sip of water. And while I'm doing that, I would really appreciate, guys, if in the chat box, you guys can go ahead and just type a quick all good here, or I have questions, Jose, whatever that is. Even if all is good, please just give me a feedback. That would help me a lot. Thank you so much. Okay. So let's go for it. Okay, let's go for it. Thank you so much, Mark, Jeff. This is great, guys. This is great. Wonderful. So what do we have? We have the matrix. I'm just gonna float it so we have more real estate on the screen. And again, the first thing we're gonna do is I'm gonna be looking for stocks that are high implied volatility. Okay, so CIV mean greater than 80. Okay, and right now what I have here has a lot to do with directional biases. So I'm just gonna uncheck any directional bias. I'm gonna be looking at my scan list, which again is not mandatory to use that scan list with penny increment options, but I do. We're gonna be looking at strength levels daily to be neutral, strength level weekly to be neutral. We're gonna look at earnings to not to happen at least in the next 15 days. And no need to use auto climate either in this particular scan. So when we do this, basically I'm looking for iron condor opportunities, and I was going to say that I just clicked even before saying it, that because implied volatility mean range greater than 80, it's a pretty demanding condition, and given the fact that the VIX is in the middle, is not too high, so I was expecting my list to be either very short or nothing in the list. So no problem. When that happens, the next step in the process of finding my trades will be to change the method instead of looking for such an extreme condition of mean greater than 80, I'm going to look at mean minus historic above 2 standard deviation, which is also a very good condition for high implied volatility option. And again, same story, because it's a very demanding condition too, so I got nothing in the list. Okay, no problem. We're going to go for option number 3, which is the one that normally gives us the greatest amount of choices, okay, which is to look for the greatest increase in the CIV mean in the last 5 days. That's the one we're going to choose. And here I would expect exactly a few. So we got 1, 2, 3, 4, 5. So I'm just going to be looking at those stocks, see if we can plan an iron condor. And then what I'll do is, using this very same settings, so instead of looking at high volatility, I'm going to look at low volatility, starting with mean less than 20, right? And when I look at high volatility, like now, I'm going to be looking for iron condors. When I look at less than 20, which is low volatility, hopefully I'll have time for that, then I'm going to be looking for double calendars. Hopefully today we can end the session with one of each, okay? So let's begin with ATVI, okay? And let's take a look at the chart and see what the chart has to offer us, okay? So we obviously have multiple expiration dates here with ATVI. Earnings are happening very far from now, all the way on August. So we could use all the way to July 15. Okay, so that's a pretty nice amount of choices. Now, too many choices also mean a lot of wasted time when looking for the opportunity. Too many choices also may mean some choices may not have liquidity, things like that. So again, one way to try to understand a bit better what's logical or useful for us is to turn on, okay, the volatility skew, so we can be looking at levels of volatility and get to understand a bit better what's happening out there. So I am loading calls and puts. I'm going to be loading 10 strikes. And we go. So maximize this so we can make it very large, okay? And I would like to get a feel for that implied volatility, okay? And it looks like, wow, that's pretty interesting. It looks like almost everything, it's very, very similar. I mean, the red line catches my attention. Obviously, normally the front wick is the one highest, but then also the green lines, which is June 24, seem to have plenty of volatility, and also the pink July 1st also seem to have plenty of volatility. And the one that has the least, which is the typical thing, is the July 15, which is the longest expiration date. So I'm going to go ahead and ignore July A and July 15. And I'm going to go ahead and give the other expiration dates a chance because they're very similar. Well, some of them seem to have more implied volatility than others. They are quite similar. So I'm going to look at June 10, June 17, June 24, and July 1st. Okay. So let's go ahead and load our spread select. I'm going to be looking at building short iron condors. I am going to be looking at 10, 17, 24, July 1st. We're going to be looking at 4 expiration dates. Okay. We're going to be using options filters. I want to load my template for iron condors, which is very demanding. And we're going to do minimum 1 and maximum 2. Okay, this is a $77 stock. So update, and then I'm going to build 99 condors and see what happens. So let's sort this, and we got a bunch of passes starting with June 17. Okay, June 17 passes, but notice that nothing passes on June 10. Okay, so while we have selected the date June 10, nothing passes. Okay, so we're going to be focusing on June 17, okay, which has the extremes set where the red line is, which is 83.73. Okay, so 83.73. So let's take a look. We got 81, we got 87, 87 and 73. Okay, so these would pass, but I have a concern here, which is there is a missing quote meaning that there is no bid size. Market makers are not willing to take that one, so I'm expecting struggles to get filled. So I'm going to skip that and see if I can find another combination. And 87, 74, 79, 80, okay, and now we get into July 1st. Okay, so yeah, so we're gonna have to get rid of June and restart our process using July and see if July will make this work. So let's sort. So July 1st, looking at July 1st, okay, notice that June 24 also didn't give us anything. Okay, so we are looking at those values, which is 84 and 71 and a half. Okay, so 84 something, 71 and a half. So let's take a look. 87, 72 almost. I went too fast. 87, 71 and a half. This could be, but we're also missing quotes. So I'm not going to take this one. 87, 72, not good. It's 71. Yeah. And then we get there. Yeah, and it doesn't pass anymore. Okay. So then my last choice. Then it seems that we may not have enough premium. Okay. This is the importance of using the filters, right? Um, Notice that with the matrix, we just found the options with the greatest volatility possible, right? But the fact that the volatility is the greatest possible doesn't mean it's good enough. Okay, it doesn't mean it's good enough. Okay, yeah, June 1st, actually July 1st was the last one. Sorry, I almost got confused there. Okay, so then we're gonna go to the next one. And again, so what do you do if volatility is not enough? Well, you go for the next stock. That's what you do. Okay, so the next stock is a $57 stock. I would prefer to pass and ideally do something a bit more spicy. So let's try Pepsi. Pepsi is often a stock, just like Coca-Cola, where the levels of premium are not that high. Um, wow, what a move on Pepsi! Amazing. I didn't notice that stock, had this type of size of a move and is falling 1.75%. We actually, maybe a good day to do an iron corner on Pepsi. Those stocks normally don't provide too much premium compared to other stocks. But after such a move and with what's happening today, we may find good premiums here. So earnings on Pepsi are happening on July 12th. So we can go as far as July 8th. So if I go back to the skew and I look at Pepsi, and I look at June 10, 24, and July 8, if I look at those, so clearly the red, as expected, is above, and then the blue and then the green. Yeah, so the sequence of premiums that we get here is very, very standard. I don't see any specific advantage. Some, a little bit of price anomalies here and there, which is, a normal thing to happen. But, this is almost like a book example of a volatility smile, which is very consistent throughout expiration dates. So, yeah, so we're going to have to test all expiration dates. And as we said, until July 8th. Okay, so let's load Pepsi on the spread select. And we're going to load 10, 17, 24, July 8. Okay, we're going to be building trades with minimum 1, and I would say maximum, I'll do maximum 3. It's a $164 stock. Okay, and we're going to go 99 and sort. And we got one pass with June 10. So let's find out what June 10 suggests. June 10 suggests, actually June 10 is here. June 10 suggests the blue line. Okay, I'm looking at the blue line. 175, 148. So 175, now we got 170, so that's not good. So we're gonna ignore June 10. And we're gonna do this again. Okay. So with June 17, we also have a few more passes. So with June 17, we are talking about 177, 145. So do we have 177? No, we don't. We have 226, but that's June 24. Okay, so we're gonna have to move to June 24. Okay, okay, June 24, only one passes. We got missing quotes. Okay, lack of liquidity here, so I'm not happy to see this. So I'm just gonna ignore it. What else do we have? July 1st. And by the way, again, when when the market conditions have been like they have been in the past weeks, where the market was crashing hard, what happens is that the fact that the market is crashing hard may or may not impact the red line, which is the implied volatility. Typically, it will, but it does definitely impact the blue lines. So what's killing us here with Pepsi is that this crazy move that took place is bringing that 1 month historical volatility line to be very far away from the red line. And therefore, unless we were to find crazy price anomalies on the option chain, it's no way our filtering conditions on the spread select tool will approve the trade, which is good because it makes you a better trader. But at the same time, it may be a bit frustrating when you are a trader and you want to find a trade quickly. Well, these are the type of days or the type of stocks in this case where you're gonna have to be a bit more patient until the trade comes to you, and make sure you don't force it. Okay. So next one in line I would like to check is gonna be Allstate. So let's take a look at Allstate. We only have monthly expiration dates, as you can see, with those vertical lines separated with a lot of space in between. So that doesn't allow me to be that efficient when it comes to tweaking. So because of that, then I'm just gonna forget about it and go for AFL, which is the next one, which does have weekly expiration dates, and earnings are happening all the way in July 27. So I could go all the way to July 15. Okay, so plenty of choices there with the AFL. So let's take a look at the skew. And let's see what we can learn. Okay, it seems it's taking a little bit of time to load. Okay, maybe I'm just gonna close it and open again, just in case there was a problem with the data feed. Maybe that. Calls and puts. And we're gonna look at 10, 24, 1, 8, all the way to 15. Okay, we're not gonna do August 19. Wow, really interesting. The green one, June 24, very high volatilities. The pink one as well, July 1st. So those are very interesting. And the other one are, I would say, more or less standard. The one I like the least is July 15, seems to be the one with the least amount of volatility. So I'm going to remove this one. And the other ones, for many strikes, they are quite the same. So I'm just going to give them an opportunity. Okay, so from all the way from June 10 to July 8. Okay, this is going to be the plan for those. So let's go for the spread select, add AFL 10, 17 for 1 and 8, 24, 1 and 8. So we're going to be building iron condors. This is a $59 stock, so we're going to do 1 to 2. We're going to be building 99. And let's sort. And let's see what passes. So using June 10, we got multiple passes. But we also have major lack of liquidity with a lot of missing bids. It seems that with June 17 is now we got bid and ask, but with June 10, look at the lack of liquidity we can see here. So I'm just gonna ignore June 10. Okay, so we don't need to look at that. And we're gonna sort again and see what is it that we get from June 17, which seems much more stable, even though I'm really not happy to see $2.15. Other strikes are fine, but some strikes are not. So let's see if we can be lucky and we get the liquidity we need and the strikes we need. So June 17 is giving us this red line located at 63.48. So we are looking at 63, but here, wait a moment, that's June 24. Okay, so June 24 will not be June 17. Yeah, so we don't have what we need. Okay, June 24. Well, I'm hoping it's not going to be one of those days where we get a no-go for an answer for every single setup, which that, by the way, happens. June 24. Yeah, I'm just looking at the liquidity. I'm not very convinced. Okay, let's see. We got 64 and 47. So do we have 64? Yes. 47? No, we don't have 47. And we are back in July 1st. Okay, so we have two more expiration days to check. Let's see. Okay, so June 1st. You guys have been very silent. I know I'm doing my thing there, so I guess you're just following. But again, a little bit of communication would be appreciated. If you could just tell me if all is good. Maybe I'm just going through these screens and I'm going too fast, so please let me know. If it's just good, please just type just good. I appreciate that very much. So July 1st, what about the statistical ranges? So we are talking about 65.46. So 65, but we don't have anything with 46. No, we don't have anything with 46. So basically we're left with the last one, which is July 8. And let's see what July 8 requires from us. So the range would be 66 to 45. So 66. No, we don't have it. Okay, so my friends, it's looking like it's going to be a tough one. So the last one to check is AGO. This one, to be honest, I never traded that stock with options. I was going to say I was expecting lack of liquidity, and look at that. We can just see it here. Only monthlies are available. So I'm just going to skip it, okay? So, hey, not a problem. We didn't find a setup with premium enough that justifies the trade based on the criteria of our spread select filtering conditions, okay, which is all of this, which we covered in other sessions. And obviously, while it's not a very good news, it's not the end of the world. Because, why? Because number one, you can always wait for a little longer and try again later in the day. And now you may have the premium, or some stock is now showing neutrality and stuff. So you can do that. Another thing you could do as well is you could actually work harder on the settings. So here I'm looking for strength level between daily and weekly. You may look at 2-day to weekly. You may look at 2-day to 3-day. So you can do different type of combinations looking for neutrality, which would be just as valid as daily and weekly. I won't do it, but just giving you ideas of things that you can do when you are not finding opportunities that are valid. Okay. In any case, my approach is going to be leave it all equal, and since the VIX is in the middle of nowhere, so we're going to be looking at double calendars. Okay, and how we're going to do that? So we're going to be looking at implied volatility to be low. And I'm going to start with technique number one, which is mean range less than 20. So let's find out if we got those. And we have a few. Okay, so let's begin with that. Let me see. Price points, $70, 35. Yeah, some of the stocks are not too liquid. Let's take a look at MedLife, $66 per share. Okay, so earnings. Oh, yes. Earnings are happening on August 3, but we don't have an expiration date lining up with earnings, so I cannot do this one. Um, Remember, I'm going to do now double calendars. So why I'm not happy with MedLife is because I would like to see that little e right next to one of those vertical lines. So now I can use that expiration date and benefit from the rise of implied volatility as earnings are approaching. But in this case, I don't know what the expiration date is going to be. It's not being released yet by the exchanges. So I cannot do it. Okay, so I'm going to be looking at international paper. Okay, and I may be having the same problem here. To be honest, I could make my filtering a bit better here. So I could select a range, okay, specific dates, and be like, hey, I want the earnings to be at least today's June 1st, so I want the earnings to be at least I don't know in the middle of the month, and to be before the third Friday of July. Okay, include, not exclude. I'm like, how can I be exactly? Okay, so none of those stocks are meeting that condition. So all of them have earnings too far out, and therefore we're gonna have this problem. Okay, so no problem, and that's why volatility is so low. So you gotta be, you always need to wonder why. So if volatility is so low, why is that? Well, because the risk of earnings is far, so then there is no perceived risk, and therefore implied volatility is low. Okay, it all makes sense if you think about it. So then we're gonna be looking then technique number 2, which is the mean minus historical volatility below two standard deviations. Okay, and it's still giving us nothing. And now technique number 3 is going to be, what if we got the top decrease of implied volatility mean in the last 5 days? And it's giving me 1, Delta Airlines. Okay, wow. I guess today it's a fun day with not too many opportunities here. Delta Airlines. So here we go. You see? So now we got earnings next to this particular date. So what are we going to use? Okay, well, remember, let me type. A double calendar is made of buy a call and sell a call above price, and buy a put and sell a put below price. That's a double calendar. It's called calendar because the calls we buy will use a different expiration date compared to the calls we sell. Okay, and guess what? For those calls we buy, we're gonna be using that expiration date, and for the calls we sell, we'll be using the shortest expiration date we can, and we'll keep tweaking every week, every week, every week, selling more of the shorts, knowing that we own the longs, and the longs will likely gain value because as earnings approach, that expiration date will kick in. Okay? So that's the plan. So just giving you a crash course on double calendars here, speed of the light, in case you have forgotten, because it's not a type of trade that we do too often, even though it's pretty nice. So let's define the trade. Okay, let's define the trade. Since we're gonna be looking at that, okay, I'm gonna first set what the range is for that stock, okay, which is from here all the way to here. Okay, and now that we know the range, we're gonna calculate thirds. Okay, so I'm gonna bring a calculator. We'll place it here. The top part is 49.42. So 49.42 is the top. The bottom part is 29 something, 29.3 and 29. So the size of the range is $20.13. If I divide this by 3, that is 6.71, which if I add to 29.29, which is the bottom part, gives me 36. Okay? So this would be a third. So let me draw it. $36. That would be a third. And the other third would be, how much we said on top, 49.45. Okay, so 49.45 minus 6.76. That would be 42.74. Okay, so 42.74, which is more or less here. Okay, so in other words, upper third, middle third, lower third. And the idea with that in mind is to go ahead and buy a call, sell a call. Okay? And then this would be located using those strikes. And then at a lower strike, you would buy a put and sell a put. And these would be located, at a lower strike. That's the plan. Okay. Now, what strikes are available, etc. Let's take a look. So we're going to be looking at July 15 expiration date. Let me open a chain. I'll take a sip of water, guys, if you don't mind. Delta Airlines. We're going to be looking at July 15 expiration date. Okay. And as you can see, the strikes available are, we got 43, we got 36. So the strikes are available. Okay. Liquidity is very nice with Delta Airlines, so not a problem. So everything is looking good. Now, I was pointing at 42.74. So in some stocks, you may have the 42.5, and this could have been a good one. But in this case, it's going to be 43 and 36. Okay, so these particular strikes here are going to be 43. And on the bottom part, it's going to be 36. Like that, like this. Okay, that's the plan. What else? So if I look at, actually, I don't need to open another skew. We already have one. Let me bring it up. So if I look at Delta Airlines and we look at the various implied volatility available, and I'm going to start with July 15 because this one I need to buy it for sure because this is the one that will gain value as earnings approach, right? So if I look at what if I use June 10 against that, well, for sure I'm going to get more premium. Okay, well, not for sure, but almost every case is going to be like that. But the question is not about June 10, it's about what if I use June 17 instead. Okay, and June 17 you can see is providing less. Okay, so this is clearly confirming to us that June 10 combined with July 15, it's the way to do it. Okay, having said that, Delta Airlines is a $40 stock, so it's not like June 10 is going to pay that much. So let's take a look at how much we get paid if we do 36 and 43 strikes on the option chain. Okay, so how much we get paid? Well, if you buy the 43 call, you're gonna pay 126. If you sell the 43 call, you're gonna receive 20 something. If you buy the 36 put, you're gonna pay 1 something. If you sell the 36 put, you're gonna get paid 20 something cents. It's fine. It's not like they're paying us 5 cents and you pay more on commissions than what you get from the option. It's fine. Knowing that, this is only June 10, then you're going to do June 17, then you're going to do July 1, then July 24, and then July 1st, then July 8. And we're going to keep rolling and rolling and rolling, exposing ourselves to be in a good position to benefit from the rise of implied volatility into earnings. Okay. So it's looking good. And therefore, let me put the trade in place here. We are going to be buying the 36 call and selling the 36 call. And we're going to be, did I say 36 call? That was silly. 43. We are buying the 43 call and selling the 43 call. And we are buying the 36 put and we are selling the 36 put. Okay. So take a look at this trade. Okay, take a look at this trade. So if we look at this trade, okay, the most we can lose is $210. Why? Because that's the debit paid. So you cannot lose more than that. Okay, so that's an easy starting point. That's the risk of the trade per contract. Okay, so just know this, so you know the multiplier in case you want to trade this trade with more than one contract, in case you even choose to take this trade, which is obviously your decision. So now notice that if the stock stays in some certain places, we end up in the green zone. Okay, but all of this is charted all the way to June 10 expiration. Okay, what's going to happen in the following weeks is that we're going to roll those June 10 expiration to the next week and the next week, and every time we are bringing new premium, let's say every week you get another 50 cents, like 20 plus cents for the call, 20 plus cents for the put. I'm just rounding it up to 50. So if every week you bring in 50 cents, after 4 weeks you are out of risk, because 4 times 50 is $200, which is the risk of the trade. So now you have no risk. And now, if earnings take place, next thing you know, now you have a profit, and you made the trade risk-free throughout its life in a way that is quite natural. So we're gonna go for this, okay? Also, for the ones of you seeing this for the first time, notice that as implied volatility rises, which I'm simulating, notice what's happening. The green zone expands. Okay, so this is kind of like the effect and what we are expecting and looking forward to see as we are approaching earnings. Okay, again, we are far from that because it's going to be close to July 15. But again, that's the intention behind this trade. Okay, so this trade is valid. Okay, and I'm just going to go ahead and execute this trade. I'm going to go here and type Delta Airlines, select July 15 as well as June 10. And we'll start with July 15. We are dealing with a 43 strike. So I'm going to add that. Then I'm going to sell the 43 strike from June 10. Then since I'm selling, let's keep selling. I'm going to sell the 36 strike puts from June 10 and then buy the 36 put from July 15. So let's review. 15 July, call put 43.36, bye bye, yes. June 10, 43.36, call put, yes. Sell, yes. Net debit to be paid 2.09. So let's go for it. And we'll see if I get filled. If not, I'll push it because we are almost concluding the session and I want to make sure I have it so I can document it and discuss the management of this trade into future sessions. But it's it's basically on the screen. So I'm just gonna try to give it a little push. Maybe I'll try 205 and see what happens. It's a fairly liquid stock, so I would expect that this should be given to me, even though it's a simulated account what I'm using for the sessions. So may or may not, but we'll see. Okay. In any case, guys, feedback, questions. Maybe the worst time to ask you because you may be busy trying to replicate this on your computer screen. So if you don't respond, I understand. But if you could respond, that would be really cool. So let me know. In the meantime, I will dock my matrix. I will close my skew. I don't need it anymore. I don't need the option chain either. Okay. So let's give it a push to the trade. Please do not do what I'm about to do. I often during the sessions use market orders with options. Never do that. I'm doing it so I can get the fields, so I can document it. That's it. I got the field. I got 211. Of course. I tried 205 instead of trying more than 209. That was silly of me. I guess it was a long day. Anyway, I got my fields. Okay, so the fields I got are 127, 133. Okay, so 127, 133. Oh, buy 127, 133. And for the sell 20 to 27, which is 211. Here we go. So here's my trade, which I'm now gonna copy, and I'm gonna place in my positions panel, so we can talk about it in future sessions. My friends, we're done. Perfect timing to conclude this trade. I'll just wait a minute in case there is anything coming in the chat box before I say bye. Mark, I totally get that, my friend. Totally that get it. But I really appreciate that even you are putting the trade on Thinkorswim. You are actually still interacting with me on the chat box. This is very appreciated. Again, it's there are so many things to talk about when dealing with options in general. No matter trade, no matter which market you trade, there are so many details, so many subtlenesses, isn't it? That not communicating properly makes it difficult for me to help you to help you the best. I meant to say. So when you guys get back to me, even if it's a quick hello, okay, not okay, certainly it still makes a big difference on my end. Very good, perfect. Okay, so I guess that we are good to go. I'm just gonna add one more mark on the chart, so then we can basically track this trade, so we know when the trade was taken. It was here on that day. Okay, and we can comment further in future sessions. So I'll save the desktop. So that's it. We have it all ready for the next session. My friends, thank you so much for joining me. Enjoy the rest of the week. I will be missing tomorrow, Thursday session. You probably have seen that in the calendar. It's not possible for me to be with you tomorrow. Sorry about that, but sometimes it's like this. So thanks for joining me today on Wednesday, and looking forward to the next one. You guys take care. I will see you again on Sunday when we do the top session. Take care, everybody. Bye-bye.